1929, U6 was at 4%. Within a period of 10 months, U6 went from 4% to 26%. So that's what was happening in the precursor to the Great Depression. In a very short period of time, we went from a highly robust, highly employed economy in the U.S. to one where 25% of the people were out of work. So that's not this level, it's a lot higher. But the interesting thing there, the comparison there is, it happened fast and it happened hard in that 1929-30 period of time. How's Canada doing unemployment-wise? We've got the U.S. in the blue line at the bottom. So here's 9.6 here. Canada is doing quite well right now. We're just 7.5%. But what you see over time is Canada's unemployment rate. This goes back to 1970. Canada's unemployment rate has tracked the U.S. rate, but with a significant gap to the upside. So what we're seeing is that the Canadian economy, by many measures, is doing quite well. So you may have seen the announcement yesterday that the Bank of Canada put out, and Governor Mark Carney keeping interest rates where they were. A more important document came out today. It was released this morning. This is the Monetary Policy Report. This is a summary report that you can get from the Bank of Canada website. Doesn't get a lot of press, but this, just in the summary, has a significant amount of detail that talks about the differences between Canadian and U.S. economy. So that's there for you to read. These are the kinds of things we try to get behind what the headlines are to understand what's driving these kinds of differentials. So part of the reason that the Bank of Canada has felt confident about pushing rates up, even though it kept it level for this last round, pushing them up, is this very differential, that the Canadian economy is relatively robust compared to the U.S. But part of what the Bank of Canada is saying now is there are more risks to that recovery in Canada than what they anticipated even 3 months ago. And that's what that document talks about today. Very interesting background to what's going on from people who are spending a lot of time at looking at the Canadian economy vis-a-vis the U.S. economy. I'm going to move to our third factor, which is the U.S. banking system. Now, I'm going to show you this as a graph or a graphic that shows U.S. financial institutions that are troubled. I could have shown you a graphic that shows failed U.S. financial institutions and gone and used this same time period, 1990 to 2010. Why wouldn't I do that? Because it's completely distorted by two things. One is, back to 1990, the S&L crisis, I'd have to have the chart up here to tell you how many failed institutions there were in 1990, 1991, because the savings and loans companies failed en masse, and it caused significant havoc in the marketplace. The other end of the spectrum, I'd have to have the chart up here to measure the failure of Washington Mutual. Just one bank alone would have put this chart way up here. So what I'm just showing here, and this is more relevant to the trends we're trying to follow, is where are the troubled banks? The 19 large banks in the U.S., you remember April a year ago, were put through a stress test. And I think it's pretty apparent to everybody now that stress test was designed for all 19 to pass. Europeans did it. They tested 91 banks. 7 didn't pass. So this wasn't exactly a stress test that was designed to implement policy or have banks change a lot of the things they're doing. It was done more to help us feel like things were getting better. And it helped. It helped give people confidence that the banking system in the U.S. had some restored stability to it. But what we've got right now, if you look at this 2008 through to the current levels, we still have a large number of troubled financial institutions, especially by historical standards, which is this line here, where almost nothing failed. Almost nothing was troubled. So if you look at this in these two periods, this tells us there were big problems, and this isn't necessarily a very positive picture for the U.S. economy, mainly because of this factor. And I'll show you this. We use this as a way to track what's going on in the difference between large U.S. banks and smaller regional banks. The top line is an index of large bank stocks going back to January 2009, so before the market started to move up. And you can see that those larger banks, those 19 large banks, are doing fairly well, especially after April 2009, they started to climb. We're safe. We're not under stress. And to the point today where they're still above that line. They're at a fairly good place in terms of the sentiment that investors have, the confidence investors have in those banks. This bottom line is a KBW index of regional banks in the U.S. And it is not doing well. The significance here is that it's regional banks that lend money to small and medium-sized businesses. And it's small and medium-sized businesses that drive the majority of economic growth. It's not large businesses. They keep it moving along. It forms the engine, but it's not what is really driving the upside to growth. So this is something we're following very closely to see what the trend is, and going back again here to see what's the trend in these troubled institutions, and then following how investors are feeling about regional banks in the U.S. These things need to improve before we can say this is a sustainable recovery. Again, back to the thesis, U.S. consumer needs to be revived, U.S. consumption needs to get going more, and it has to be driven to a great extent by what's going on in the economy, which is going to be fueled by regional banks lending money to small and mid-sized businesses. So there's a lot going on behind the headlines. This is my second economics geek slide, so forgive me or indulge me anyway. And I say that because this is acronym laden. This is what is known as the LIBOR-OIS spread. So in the second level of plain English, London interbank offered rate over the overnight interest swap rate. So to try to make that a little more understandable, LIBOR is the rate at which banks, the 16 largest banks in the world, decide to lend each other money at. And that happens every day. It's set every day. So they're really saying, no, this is what we think the creditworthiness of our partner, large 16 banks, are. So that gives us an idea of what's going on between banks. OIS is essentially the risk-free rate. It's U.S. Treasury bills, but measured as an overnight interest swap. The reason we use that is because it trades every day. You can get measurements on it by the minute if you need to. But it's something that we can go. Some of you may remember TED spread, very similar in terms of what it does, the signals it gives. So, what does it mean? Well, this looks pretty good. This doesn't look so good. This is October 10th, 2008. This is Lehman Brothers right here, and this is the aftermath. So this steep increase is the result of Lehman Brothers failing, primarily. This is our crisis. And the reason is, if you look at this and say, what does it tell us? It says, first of all, the number here is, over the longer term, is 10 basis points. So that spread between what banks would lend to each other at and the risk-free rate was 0.1%. Basically, banks are saying, no risk for me to lend to another bank. That went to 364 basis points, 3.64%. This is gargantuan in the fixed income market. Basically, it's saying, we don't want to lend to anybody. We're not sure we're going to get our money back. And that's what goes through their minds when they're looking at that. Paul O'Neill, the former Treasury Secretary of the U.S., used an analogy.